We will be getting started in about a minute as we let people come on board, so stand by. Hi, and welcome to our webinar on one of CFP Board's major strategic initiatives, the Client Impact Study. Hello, I'm Kevin Roth, Managing Director of Research here at CFP Board. I'm excited to introduce today's webinar, where we'll get an update on this ambitious research study that, for at least the next decade, will look at the impact of holistic financial planning has on clients and society more broadly. The key focus of today's webinar, we will be learning about the research team's progress. Last summer, they launched the first survey of this project, where they heard from more than 4,000 Americans. Today, they will share some of the key findings from that survey, which I'm sure you'll find both exciting and intriguing. I will also encourage you to download the copy of the report that we've prepared with some of the first-year study highlights. At the very end of their presentation, they will share a QR code where you can learn more about the project, download the report with some of the 2024 survey highlights, and of course, share some of your feedback. I hope everyone finds today's conversation engaging, and I encourage you to share feedback on what you will hear. While we've disabled the live chat, you can share your questions and comments by clicking on the Q&A button that's at the very bottom of the screen. Time permitting, the researchers will address your questions following their presentation. And with that, let me turn the floor over to the research team. Let's start with Dr. Sonia Luter. Sonia?
Thanks, Kevin. Thank you all for being here today. It's a really energizing project that we're working on, and we're excited to share some of the initial results with you all. Dr. Collins and I will be giving the presentation today, and to reiterate, Dr. Roth, we would very much love to see your questions over in the Q&A. And we are supported by our team, but they are not joining us live today, Dr. Heckman and Dr. Kushel. So with that, let me give you a reminder of what this project is all about. Oh, there's our beautiful pictures, but now I'll tell you more about our project. There we go. We're really interested in looking at the outcomes of financial planning, and that seems like a bit of an easy task at first until you start getting into some of the complexities of it. We are looking at financial outcomes associated with using financial planning, but also non-financial outcomes. We are not only looking at CFP professional advised households, but extending this to other types of financial planning or financial advice, professional services that people are getting. And then also we have a large number of do-it-yourself households who maybe say that they're doing some sort of financial planning, but they're doing it on their own. And then other folks who are not doing any sort of planning on their own or with anybody else. This is going to be examined over at least 10 years. We are now complete with year 1. So we're going to show you some of the measurable differences among these 3 groups, but this is not yet capturing maybe some of the treatment effects that we'll start seeing in years 2 through 10 and beyond. As I mentioned, there are a number of theoretical and methodological issues that we are taking into consideration. First of all, who is it that's using a financial planner? With these selection issues, we're interested not only in if a person has somebody, but why they are using that particular person versus somebody else. The biggest issue here is the treatment effects and the heterogeneity issues that are at play here, and categorizing people into these 3 groups of CFP professionals, non-CFP professionals, or do-it-yourself households. And we are trying to figure out not only if they're using one of those people, so if they're using a CFP professional, but if they're using a CFP professional and somebody else, for instance. And then also looking at the comprehensiveness of those services and categorizing people correctly into the type of financial planning advice that they are receiving. It may be a one-time engagement. It may be something that's more in-depth and more of an ongoing relationship. So those are some of the treatment issues that we're starting to look at right now. And then looking at the outcomes and looking at these in a way that's easily understandable to consumers, but also to you all as the professionals. And how can we make this information as usable as possible in everyday life? So at the end, we're going to introduce some ideas that we have there with the scoring mechanism, and that will continue to be refined over the next year or two. We did pilot test all of these measures, and then today, we're not showing you any of the results of the pilot data, but more the results of the first round of data. Some of you have seen this before. This is how we are looking at financial wellness. It's really exciting to see so much literature focused on growing financial wellness and well-being among consumers. The issue that we have right now is getting on the same page with what does that mean? The words are often used interchangeably, but in fact, we're looking at financial wellness in a very unique and purposeful way as the combination of being objectively healthy. So having good financial ratios, being in a good spot for a person's life stage, and feeling good about where they are. And it's easy to think of examples where a person might be objectively good, objectively healthy, and yet they don't feel good about their situation. So we want to capture both ends of that and use that combined score of financial wellness as the acting, the thinking, and the feeling content and fulfilled with one's financial satisfaction. If you broaden that out a bit, we'll see on the next slide how it is the combination of these three things that are important. And it's fairly common to see examples of outcomes in the resource management side of things. So how a person is managing their emergency fund. Do they have adequate insurance? Are they on track with their other resource needs, net worth, income, etc.? So that is still a very important thing that we're looking at, but we also want to know how people feel about that situation. So you'll see here the word financial well-being as a subjective element as a part of the broader wellness framework. And then a really big one that is becoming more relevant with the CFP Board Psychology of Financial Planning competency is the psychological social condition. So in here, we're capturing people's thoughts and beliefs as they pertain to both of that resource management and financial well-being side of things. And it's really helpful to get people's perceptions of their past experiences as that's influencing current behavior. So now this is the big reveal of the Financial Planning Longitudinal Study of 2024, the FPLS 24. And our target sample looks familiar to what you may recognize from some of our pilot studies. That is on purpose. We are looking at, generally speaking, working aged adults, aged 25 to 65, and minimum income and assets of 50,000. I'm going to come back to the assets in just a second. We did require that everybody be at least a high school graduate or the equivalent. The financial decision maker. So we asked people, are you responsible for making financial decisions in your household? And it was, yes, they're the primary decision maker, or they share decision making, or they don't have any influence in the decision making within the household. And we only capture the people who are either the primary financial decision maker or the shared financial decision maker. It doesn't mean that we're not interested in people who are not making the financial decisions, but we wanted people who could accurately capture the data that it was that we were looking for, particularly on the resource management side. We do want people who are either employed, or we did capture people who had recently retired. And that's so that we can see that transition in and out of some key life stages there. The data were collected this past summer. 4,027 people gave us complete data for that. I said I was going to come back to the assets. And the reason why is we did have the 50,000 initial minimum for the investable assets, but we ended up lowering it to 30,000 to capture some households that might transition into the panel. Remember, we are following these people for the course of 10 years. So there's a lot of life that happens within that, particularly for our young people who might be in graduate school. So maybe they don't have a lot of assets just now, or maybe they're just starting their first job. And we want to capture that transition of building the assets, and what does that mean for where people are seeking advice, if they are at all. Are they going to the CFP professional? Are they choosing an accountant? Are they choosing a different type of professional? So this wide range of minimums and the different categories that we have here are meant to allow us to see those changes over the next 10 years. We are very lucky to have an amazing research partner at NORC, and they're the ones who captured the data for us through their AmeriSpeak panel. And they will continue to be collecting the data for us with the FPLS 25 and beyond. With that, we are now into the most exciting part, and Dr. Collins will share with you some of our baseline results that we see.
Great, thank you. Yeah, and I just want to echo how much we appreciate the work of the NERC at University of Chicago and the AmeriSpeaks panel. It's been a just amazing process of designing these surveys and gathering these data. So as you heard, we got about 4,000 respondents to these data, and then we're able to actually weight them as well, so we can kind of get a representative sample of the populations that we're interested in. But one of our key questions here is who uses a financial planner, which turned out to be a little trickier than maybe you might imagine. So not everyone necessarily identifies themselves as using a financial planner. And then particularly this notion of a CFP professional isn't something that everybody's sure of. So in our overall panel, 33% of people said that they used a financial planner, meaning 1/3, and then 2/3 said they did not use a financial planner. Among those who said they used a financial planner, about half, 51%, said they were certain that their planner had a CFP designation. Um, only 8% were certain that they didn't, and 41% were uncertain. So we're going to really hone in on these people who say that they had a financial planner and they're certain that financial planner has a CFP. We feel pretty confident that they're reporting accurately about their experience. And then we're going to categorize those who say they have a financial planner, but either aren't sure or sure that they don't have a CFP as sort of an other professional group. And so you'll see that throughout our chart, the tables and charts today. All right, so the first thing we want to talk a little about is this: who uses a financial planner? And so we're going to start with looking at income. So across the bottom of this graph, you'll see different income categories ranging from 50,000 on the far left side up to 200,000 or more on the far right side. Our black bars are going to be the unadvised population. The yellow bars are the advised population, and the gray ones are those who are advised and are certain that their advisor is a CFP professional. And the main trend I think you'll see here is just the gray bars tend to be skewed towards the higher income side, and the black bars tend to be skewed towards the lower income side. And so this is pretty consistent with what we might have thought, that people who have more resources, have more income, are more likely to use a planner. But it's also, in most cases, you can compare the advised to the CFP advised and see that the CFP advised is even higher income than the advised group. So we see these big differences at both the upper end for the advised or CFP advised group versus the non-advised. And at the lower end, it's just the opposite. So a larger distribution of those without advisors there. And then if we just compare the CFP advised to the advised group, the yellow bars to the gray bars, we can see that the gray bars outpace the yellow bars, especially at the higher income levels, starting at about $100,000 in income. But from that point on, the distribution of people who use a CFP advisor tends to be at a higher level than those of the non-CFP advised. We can do the same kind of a graph here with assets. So across the bottom, these dollars are the amount of assets that people are asked about. So we only include here investable financial assets. So this includes real estate or personal property. It's really, or even businesses. So this is their investable financial assets. And you can see again, the black bars are the unadvised. They skew towards the lower end. The gray bars are the CFP advised. They skew towards the higher end. And so we, see the same kind of pattern where people who use an advisor tend to have more assets, and people who use a CFP advisor tend to have more assets than those who just use a non-CFP advisor. And we see this even more when we just compare the two side by side, particularly if you look at the $1 million plus, add up those bars, and it's about a quarter of the CFP advised are in that $1 million or more in investable assets group. And that's significantly more, almost double the level of those who use an advisor who either they're sure is not a CFP or they don't know. Then we can look a little bit deeper into the unadvised group. So those are the black bars before, the advised group, and then the CFP advised. The first item on this table is a financial literacy score. So it's a standard set of 5 questions that's widely used across surveys. It asks things that basically try to get it. Do people understand the basics of inflation? Do they understand compound interest? Do they understand the idea of a portfolio is going to be less risky than a single stock, those kinds of things. So, the average person in the unadvised group got about 3.4 of those questions correct. The advised group is pretty similar. The CFP advised group got almost 4 questions, 3.9 questions correct. So this just suggests that those people who use a CFP advisor are a little more financially literate, a little more familiar with financial terms and concepts. We can't say that the advisor made them smarter. Maybe because they're smarter, they use an advisor. We don't know. But we do see a pattern where they have higher levels of financial knowledge. We can ask a similar set of questions around risk taking, and this is a 10-point scale where people say either they're not willing to take any financial risk, or at the maximum, I'm willing to take all the risk I can. And so we do see that, and higher means more risk. So in this case, the CFP advised group is a 5.8 out of 10. Not willing to take massive risks, but definitely higher risks than the unadvised or the non-CFP advised groups. The next set of questions here in this table are around people's senses of their own financial state. So they're confident in their ability to achieve financial goals, that they use money to create joy and happiness, that the adults in their life discussed finances when they were growing up, that the adults in their life gave them opportunities when they were growing up, and also a question about their expectations about the economy. You can see that the levels of differences here are not giant. So we see, definitely a higher level of confidence among the CFP advised than the unadvised, but not too much higher than the advised group in terms of their ability to reach their financial goals. And I would say too, we're measuring this confidence as a strongly agree. So 31% of those people in the CFP advised group say that they're strongly agree that they can achieve their financial goals, which is, I think, a strong indicator that they're on track. Asking about whether people use money to create joy and happiness, then that strongly agree. It's about 23% of the CFP advised, about 19% of the advised. These are pretty similar across these measures. Thinking about people's socialization, how much the adults in their life discuss their finances. Again, there's a higher reporting rate among the CFP advised, but it's only 13%, and not huge differences across these groups. If we look at, again, the number of opportunities that adults gave people when they were younger, it's about 16% say strongly agree for the CFP advised group. Definitely higher than the unadvised group and a little bit higher than the advised group. And then finally, expectations about the economy. Overall, the unadvised group has some more pessimistic perceptions of where the economy will be next year. This was taken over the summer, so this was back in June, July. 26% of the advised group and 23% of the CFP advised group. So, I think these differences tell us that there are underlying differences across these different populations, but they're not dramatically different as we look at them. Another question we asked, and this was only asked of the CFP advised and the non-CFP advised groups, is what sources of information they used in the last 12 months in order to make financial decisions. So among the CFP advised group, more than 3/4, 77% said that they used their planner or advisor to make a financial decision. And it was only about 57% of the non-CFP advised group. So I think this tells us that the CFP advised people in our survey just have a deeper relationship. They're more likely to consult their advisor and to do so at least annually in this case. Other sources of information that people relied on, pretty similar across the groups in general. Friends and family was the second most commonly cited. Accountants, probably not too surprising. About 1/4 of the sample said that they used an accountant for a financial decision in the last 12 months. Similar online resources and digital sources were about 1/4 of the sample. A bank, credit union, or a lender was about 15 to 19% of the sample. Brokerage firm representatives, 13 to 15%. Employer or an employee program, assistance program, was only about 10%. And then a smaller percentage said lawyer. So between 4 and 7%. So, we take this to mainly, recognize that the advisor is playing a big role. But also there's other sources that people are relying on too. And so we're going to do more analysis in the future on these combinations of advisors with other resources and how that might lead to people having different perceptions and even different outcomes. All right, now I'm going to turn a little bit to the types of services that people, again, this is among those who either had a CFP advisor or a non-CFP advisor. So they all have some kind of a financial planning relationship. But we want to understand just how deep is that relationship and what kinds of things are the planner and the client engaging in. So on the left side here, we have this type of financial plan. So we basically defined a simple financial plan as, one or maybe two different services that are being provided. So for example, a really simple retirement projection, or maybe some tax planning, maybe a one-off, not an in-depth financial planning relationship. A complex financial plan means that it has multiple services, so two or more different services that might be an ongoing engagement with the client. And you can see here that there are a lot of simple plans out there. A lot of people who use an advisor for just one or two items. But there are some that have no formal plan at all. They really are just using an advisor for a particular discrete needs and, then relying on their own do-it-yourself, I guess, for the rest. But we see for the CFP advised, only 19% have no formal plan. So, 1 in 5, or more accurately, 4 in 5, have a formal plan that they work on with their advisor. Among the non-CFP advised, 31% don't have a plan. So almost 1/3 of those who don't use a CFP advisor don't have a formal plan. And that formal plan really is, I think, a strong indicator of people's depth of their financial planning relationship. We can compare again the gold and black bars here. So the gold bars are the CFP advised and the black are the non-CFP advised. In all cases, the gold bars are sometimes much higher percentages than the non-CFP advised. So the tax is about 27% of the CFP advised, about 1/3, 35% engage in risk management and insurance topics. The majority, 55%, are engaged in retirement planning. 22% are discussing the psychology of financial planning, which is a relatively newer competency, but we're seeing pretty high levels of reporting on that. Investments, about 52%, again, the majority for the CFP advised, and then estate issues, about 1/3 or 31%. So in some cases, the gaps between the non-CFP and the CFP advised are quite large, 20 points or more difference in these different groups. And to us, it just says that the CFP advisor engaging in a deeper level of more comprehensive financial planning. Some other measures of this level of client engagement, again, comparing the advised group to the CFP advised group. About 27% of the non-CFP advised group has only worked with a financial professional for 1 or 2 years, as opposed to the only 22% of the CFP advised has only worked with a planner for such a short period of time. In terms of, does the financial planner handle almost everything of my financial side? So it's about 34% of the CFP advised and 31% of the advised said that's true. I think maybe more interesting are when we ask people about what their planner engages with them in their planning sessions. So one of the questions was, does your planner make an effort, or does your financial advising professional make an effort to learn about your family and values? And the percentages here are the percent who said a lot. So my professional spends a lot of effort to learn about my family and values. 53% of the CFP advised respondents said that was true. Only 33% of the non-CFP group said that. So a much, much higher rate of kind of these non-financial factors, but we know those are really important for planning. Another question here is, they make an effort to learn about my spouse's relationship with money. Almost half, 49% of the CFP advised group said that, said a lot, and only 30% of the advised group. So again, the depth and the breadth, I think, of the advising relationship looks different between these two groups.
Great. Thank you, Michael. I'm going to talk through some of the outcomes. Remember, this is the triangle where we had the resource management, the psychosocial, and then the well-being elements. Again, the pattern remains pretty consistent to where you will see the CFP advised group being better, reporting higher percentages in these different resource management outcomes. You'll notice the second one is reverse coded. The number or the bars are pretty similar with that one, but it is indicating whether or not a person unexpectedly had to pay income taxes within the last 3 years. So here we would actually want a smaller number or a smaller percentage in that category, which we do see for the CFP advised group. Not a lot of difference there. Here, you'll see that we are trying to capture most of the areas of financial planning that we can get with a clear resource management item. From the emergency funds, we've got the piece on tax. We have the two middle ones that are addressing some insurance needs, and then the last two addressing some of those estate planning needs. The next slide, we will see the psychosocial elements. And here, I see a lot of familiar people on the participant list. And you know that I get really excited about this stuff because this is one of those real areas where we can make an impact in a person's life by not only addressing the financial side of things, but the person side of things. And here, most of these we're going to want, it depends how they're phrased. Let's just go one by one. So this first one, we asked how the percentage of people that felt like they were worse off than their peers. And you'll see that we're reporting this percent that strongly disagree. So the higher number, the better here, that they disagree that they are worse off than their peers. And the pattern remains pretty consistent there. Not a lot of variability in who could receive financial support in a crisis, but it's all quite high. So that's really excellent for the respondents there. And then the next two are also the percent who strongly disagree with these items. So that way we can see that the higher number is the more positive outcome here, that 35% strongly disagree that they have too much debt among the CFP advised group, a little bit less for the advised, and then quite a bit less for the unadvised group. Same pattern on that frequency of financial conflict over money. And it looks pretty similar among the advised and CFP advised groups here of the percentage who disagree that they're frequently arguing over money conflict. And then the money anxiety is really quite fascinating here, that we see that the lowest percentage, and it's quite a bit lower for the CFP advised, feeling like they had financial anxiety. financial well-being wise, this is how people feel about their situation. And we do have some more general questions. So feeling completely satisfied with financial life. So that's pretty broad reaching. And the CFP advised group is so much higher than both of the other groups, particularly if you look at unadvised versus CFP advised, but a definite benefit going from left to right of these feeling comfortable with where a person is. The next question asking, do you feel like you can live comfortably with your current financial situation? And then we had a series of 7 feelings that people could report, such as feeling confident about their finances, feeling in control. And you'll see from left to right that the number of positive feelings a person feels does go up from the unadvised through the advised and then the CFP advised groups. Okay, so here's where we are right now. We have these 3 areas: the resource management, the psychological social condition, and the financial well-being. That's the triangle from early on with our framework. These are the outcomes that we are looking to measure across 10 years. We have some really fascinating baseline data from our 4,000 some people, and we're going to survey those same 4,000 people within the next several months and see if we can see changes of people continuing to move up if they are working with the CFP professional, or perhaps there are people who move from the unadvised to an advised or a CFP professional advised group. And what are the associated outcome changes with that? So we want to have a nice, easy score that you all can use in practice or in research. And each of these 3 items, right now we have a score that we can calculate that's standardized across each of these, which makes it, we can standardize the items within each of these areas to get a score that measures, let's say from 1 to 10, how they're doing on resource management. 1 to 10, how are you doing psychosocial? 1 to 10, how do you feel about your financial situation? From that, we can then look at this at what we are affectionately calling the Consumer Financial Wellness Super Score at this moment. So the combination of those 3 things as a person's wellness, which is different from well-being, as it's clearly illustrated here. Well-being is one component of that. So our hope is that you all can use these individual scores to see how a person is doing in, let's say, resource management. And then how does this feed into their overall wellness score? Because, as I will remind you from the beginning, a person could be scoring high on resource management. They look totally fine financially, but they are being influenced by some of that anxiety issue, so the psychosocial condition, or they may just say that, no, I am not living comfortably, or I am not satisfied with my financial situation. So we are capturing ways that you can have both that overall score, but then also know where to target within the super score of maybe we need to focus more on the psychological social condition for the next meeting versus focusing in on the resource management side of things. So we're really excited for that, and more information to come on that. A couple other next steps before we get into some of your questions, and I've had some questions coming in on the Q&A. Go ahead and type them in there. And like I said, I recognize several of your names, so I'm getting some text message too of some really great questions. So keep it coming. I see a lot of fantastic researchers online. And for you, we are going to be releasing this data soon. Later on this spring, it still feels like the dead of winter where I am. Soon it will be spring, and soon we will be able to release this data for you all to use. And this is probably one of the most exciting things because there's no other data set like this. This is such a unique opportunity to get data on financial planning. There are other types of data sets that might capture a part of financial advice or whether or not a person works with a professional, but this is very specific to the financial planning process. And you saw Dr. Collins go through the different areas and the depth of areas that we're looking at, from the retirement issues to estate planning issues to insurance to tax. So we're capturing all of those, and to be able to see those differences over time is pretty exciting. The other thing with being able to see some of those changes over time is I really liked the example that Dr. Collins gave of our CFP professionals making people smarter, or are people smarter and they're opting into using the CFP professionals. Those are the exact things that we're going to be able to analyze with the longitudinal nature of this data. So the FPLS 25 will be coming later this year, and we can start exploring potentially some advisor relationship and choices within that, looking at different types of matching data that we might be able to use within that, and so forth. So as you go to the next slide, Michael, this is where you all can give us some feedback of things that you would like to see done or questions that you have. I do have some questions that I'm going to start with, but then I'm going to turn it over to you, Michael, and see what you think too. And one of the questions that I got was, what surprised you the most about this first year of data? And I'll start because I've been thinking about it as you were talking, and you can think about it as I talk. So one of the things that was, I I I wouldn't use the descriptor word surprise, but I was pleased to see those lower levels of financial anxiety amongst people who are using a professional, particularly those who are using the CFP professional. I am sort of not surprised, because that communication that people have with another person in and of itself helps to reduce some of the anxiety. But I was certainly very pleased to see that. I was surprised to see how large the difference was between the three groups. And then I'm going to do a bonus, and then I promise I'll let you talk about your surprises, because there's a lot more than what you're seeing on the slides, of course. I thought it was shocking that 41% of the people who say that they use a financial planner didn't know if their person was a CFP professional or not. And I think that's, we talked through a number of different issues of why that might be the case, of why people just don't know. It's a profession built on relationships, and they trust their person. And then they go from there. Maybe they've had this person for a decade, and they knew 10 years ago what designations their professional had, but now they don't. But I thought that was surprising, that the percentage of not knowing was approaching half of the sample. What was most surprising to you, Dr. Collins?
Yeah, I agree. And I think it's also a challenge for us as researchers because, the consumer, the client, they're not thinking about this as a, quote unquote financial planner, right? They're just thinking about, I have some issues I need help with. And so they view the relationship in all kinds of different ways. So some people clearly have very deep, long relationships where they are engaged many times a year on many different topics. And others really just see the planner as something that helps them get through a decision here and now, and maybe don't see it as an ongoing relationship. So I think sometimes our stereotypes about what that planning relationship looks like are really hard to capture in a survey because of the wide variety of experiences that people have.
Yeah. On that point, do you remember if there was clear patterns of who it was who didn't know, such as, there's a question in the chat of an assumption that perhaps the younger people didn't know if their professional was a CFP professional.
It's a good question. So I don't know the answer by age, to be honest, but we did see a pattern where the people who had the highest levels of income and assets and oftentimes those are the same people. They were the ones who are most likely not only to say that they um, were using a CFP, but that they were certain that their advisor was, or that they were using an advisor, but that they were certain that their advisor was a CFP. So I do think there's a probably a correlation with the older people also being having more resources, and so there's probably some relationship there. But it is important because the people who recognize that their advisor is a CFP also are some of the more financially literate. They're more educated. They're just more engaged, and so I think that's a key distinction in a lot of these data. We are comparing those people to the non-CFP advised. Many of them may actually have a CFP advisor. So, the differences between these groups may even be larger if we really only looked at people who had a CFP versus not.
To that point, oh, go ahead, Kevin. I'll let you
Well, I was
go
gonna
first.
say I'd like to tag on to. I know that one of our goals for the work this year is to refine our questions to help the respondent better identify who their advisor is in that sense, because of that large portion, and to maybe even to the questioner's point of this, if we could see those differences there. So we want to kind of crack that, because one of the things that the researchers did here is if the person did not definitively know that person was a CFP professional, we assumed that they were not, and we were still seeing these interesting, meaningful differences in outcomes. So
Yeah, that's great. I also wonder, Michael, if you would like to speculate on why the CFP group is so much higher. I have my own opinions, but I will let you go first. I'll put you on the spot.
Well, I think we're not the first study to show this, that people are more likely to seek out professional help when they just have more decisions to make. And so the more resources you have, the older you are, the more complicated your family situation is, the more you're going to need that help. So part of it is that. Part of it too is that they are, do they just know more about what they're doing? They're more engaged overall in their finances, whether or not they use an advisor. They're just more engaged on taxes, on estate, on all kinds of things like that. So, a younger person without a lot of assets or income probably doesn't have as much need, and so therefore isn't as engaged. So some of these patterns will be really interesting to watch over time as we see people. Maybe we have somebody in the survey right now who's 40, and when they're 48 or 49, will they still be looking the same? They might be looking very different. And some of these people will start using an advisor. And that's going to be, incredibly fascinating for us to see these people who switch from being unadvised to having an advisor, or from having a non-CFP advisor to a CFP advisor.
Yeah, absolutely. I totally agree that those CFP professional advice group are very informed, and they perhaps are organized and keeping track of everything in their life. And I think that's why we're seeing some of these patterns as well. Because remember, these are the people who are certain that their financial advisor is a CFP professional. And so there's a good portion of that 41% that could be also working with the CFP professional, but we're not capturing as big of a difference with them simply because maybe they're not as engaged or informed about the process. What about the question in the Q&A, Michael, about a correlation between those who have the subjective belief that they're on track versus an objective indicator, such as a financial ratio?
This is something we haven't looked deeply into yet. And by and large, the three different domains and three different measures that we discussed, they are correlated with each other, but it's not perfect. And you do have some people who, um, based on, say, savings ratio by age, or, some measure of, having trouble, having owed back taxes, for example, things that we might think objectively are a signal of either positive or negative financial condition. There are some people who say, I'm doing really well, and yet they have some of those more negative things. And it's certainly plausible that could be true, because maybe that's a thing in the past and now they're moving on and now they feel like they have things under control. And conversely, we see some people who, um, you know, uh, by all objective standards, seem like they're in pretty good shape. They've, got a high level of savings. They appear to be ready for a shock. They, all those indicators seem pretty positive, yet they are worried, they're anxious. And there's just it's as we all know, it's just very challenging to capture comprehensively all the things that people have going on in their financial lives and their non-financial lives, and all of that contributes to what people's perceptions are. So I think it'll be really important too to see how these things change again over time, because we might see somebody who every year looks better in terms of their objective financial measures, but their financial anxiety gets worse. And so we're going to have a lot more insights as we can track people over time.
Yeah, definitely. And as part of that tracking over time, to address several of the questions in the Q&A, yes, we are very much looking at people's transition into and out of working with a professional and the type of professional that is. So yes, every year we're going to be gathering, do you use a financial professional? Do you have a financial plan? What kind of professional are you using? And trying, as Dr. Roth mentioned, to get even more clear and more certain data on whether or not that person really is a CFP professional. So yes, we will get to see some of those transitions. I want to remind you, if you haven't scanned this link, go ahead and do that, because not only can you provide feedback, but you can also access the recording for this presentation, and you can also get a report. So the slides aren't up there, but you will be able to see a report that gives the same information. And I believe that's already there for you to look at. So go ahead and get that scanned. I have another question for you, Michael. And
Yes.
and this is a fun one of, what is the value of releasing this data for other researchers, such as those on the call, to be able to access?
Well, I think um, the analysis that we've shared with you today is really the tip of the iceberg. There is so much more that can be done. For example, we talked about people who use a CFP professional or a non-CFP professional and a lawyer and an accountant. What are the combinations of services that people need? And this could help, I think, if you're a practitioner, to think about, what are those referral sources I might need to have, or what are the services might need to have in-house. But it can also help us understand changes over time. What are the needs that people might have in the future that we can start to anticipate? So that's just one example, but the four of us are sharing with you really very high level responses, and we're going to continue to do more research, and we're going to create some papers and reports using these data. But there's so much that can be done that in some sources we just need that crowdsourcing of researchers, of graduate students, of others who can start to use these data. And again, getting in on the ground floor with year one of a longitudinal study like this is going to create some real opportunities to create some insights that I think will impact the field.
Totally agree. And I know every time I do one of these webinars, I get really excited about the psychosocial stuff, because that's my area. And the advantage of having other people look at the data is you have other passions that are equally as important for you, and you will look at it in a different way than we will look at it. We were starting to lose track of all of the different research questions that we were answering. So we have a whole spreadsheet of stuff that we're working on, and there's no shortage of stuff that can come out of this data. So we hope that you'll access it when that is released later on this spring. And unless Dr. Collins or Dr. Roth, you have final questions. Oh, I just saw one more. Let me take a second to read this in the Q&A, and then we'll close out after this question. Oh, yeah. So there's a question about, can we differentiate of how a person is paying for financial planning services, or different business models that people are using? Michael, I'm not.
This I would, if anybody's listening that has a good way for us to measure this, we'd certainly be interested. We tried some pilot questions with a prior sample to try to get at this, and people have a really, really hard time answering questions that maybe we think is just part and parcel of the way things operate. Uh, but the general reason, I think if our respondent doesn't know if their advisor is a CFP or not, it's going to be really hard for them to try to particularly if they have some more complicated fee structures to be able to report on that. So it's a really hard thing for us to ask in these surveys, unfortunately.
Yeah. It is on the radar, and I promise we really do look at the feedback that you all provide. So we're open to it. And with that, thank you again so much for coming. And it's really our pleasure to get to give these summaries for you. Follow the Client Impact Study website for all of the updates, and we will see you on the next webinar.